how does a healthcare company expect to, nearly double its earnings per share in 12 months while simultaneously planning to lose $1 billion in revenue?
Yeah, it's a massive structural contradiction, on paper at least.
Right. It's the central paradox we're staring at today on the deep dive. And if you're holding shares or analyzing the managed care space, the narrative around government-sponsored health insurance has been murky at best.
Oh, absolutely murky. You typically expect revenue growth to be, the primary driver of earnings growth.
Right.
But what we're analyzing today is this scenario where shrinking the top line is actually the catalyst for bottom line expansion.
Which is exactly what we're going to pressure test. So, welcome to Talk Tickers. For those of you joining us, our mission is always breaking down these corporate earnings calls for retail investors. We translate the Wall Street jargon into plain English, and we figure out whether a stock is a buy, a hold, or a fold.
And today we are looking at Molina Healthcare, Inc., ticker symbol MOH. Specifically, we've got their Q2 2026 earnings call transcript right in front of us.
Right, featuring their management team. And our goal today is data forward. We want to cut through the executive summary, bypass the standard Wall Street platitudes, and really dissect the underlying data.
Because the numbers themselves are solid, but they're hiding a tremendous amount of volatility beneath the surface. I mean, it's a masterclass in addition by subtraction, provided they can actually execute the maneuver.
Without triggering a death spiral in their risk pools.
Right.
So let's set the baseline, the headline numbers. For the quarter, Molina generated $10.2 billion in premium revenue.
Right. And their adjusted earnings per share, their EPS, came in at $1.51.
Yeah, $1.51. And looking forward, they updated their full year 2026 guidance. They bumped that EPS target up by 25 cents to a floor of $5.25 per share.
At least $5.25. While the top-line premium guidance, it didn't budge at all. It remains anchored at approximately $42 billion for the year.
But the metric that dictates everything in this space, the one we really need to unpack for you, is the consolidated medical care ratio, or MCR. It came in at 92.2% for the quarter. Before we go further, what exactly is an MCR, and why does a lower number mean more money in the bank?
So that 92.2% MCR is really the gravitational center of this entire analysis. In managed care, your margin for error is razor thin. An MCR of 92.2% means that for every dollar of premium Molina collects from state or federal governments, 92.2 cents is immediately walking out the door.
Walking out the door to
pay hospitals, physicians, pharmacies, actual medical care.
Leaving just 7.8 cents to cover, everything else.
Exactly. The entire general and administrative apparatus.
Yeah.
The claims processing systems, the care coordinators, the compliance teams, all of that has to come out of that 7.8 cents before you even think about generating a profit for the shareholders.
It perfectly illustrates how highly leveraged this business model is to utilization trends, right? I mean, a microscopic fluctuation in how often members go to the doctor.
It cascades into massive swings in overall profitability, especially when you apply it to a $42 billion revenue base.
Which brings us to the core thesis of this quarter's print, the so what for you, the investor. Management is guiding to that $5.25 EPS for 2026, but they are heavily telegraphing that this number is artificially suppressed.
Yeah, heavily. The headline EPS is masking a significantly higher intrinsic earning power because they're currently absorbing several massive one-time operational drags.
Which is the big mystery we're unraveling today. So the analytical challenge for you is to figure out if that $5.25 is the actual steady state reality of the business or if it's just a temporary trough.
Right. And to figure that out, we have to look at the engine room of Molina's business, which is Medicaid, segment 1. Management spent a lot of time on the call categorizing 2026 as a trough year for Medicaid margins.
Let's hit the data on that. The Medicaid MCR printed at 92.7% for Q2, and they're holding the full year guidance for the segment at a slightly elevated 92.9%.
Yeah, and they're monitoring a 1.2% pre-tax margin for the Medicaid book in 2026, which translates to roughly $5.75 per share in earnings contribution.
Which is actually up a quarter from their previous estimates, right?
Yeah.
But still operating below their long-term target margin.
Way below. And the fundamental tension driving that margin compression is the disconnect between the medical cost trend and the state rate updates.
Right. Management explicitly noted this. They said their medical cost trend is running at 5%. But the state rate updates, the actual revenue increases they're receiving from the states to manage these populations, are only coming in at 4%.
It's a squeeze.
A huge squeeze. Wait, if your liabilities are compounding at 5% and your assets are only growing at 4%, aren't you slowly bleeding out? Why is management calling this a trough year instead of a structural bleed?
Well, it would be a terminal bleed if the rates were permanently decoupled from the trend. But the mechanics of managed Medicaid guarantee that they aren't. The friction you're seeing here is purely a function of actuarial lag.
Actuarial lag, meaning the states aren't pricing risk in real time.
Precisely. Think about the mechanics of how a state sets a Medicaid capitation rate. State actuaries require finalized, fully adjudicated claims data to build their forward-looking models.
So they're looking in the rearview mirror.
Exactly. They're looking at data from 12 to 18 months ago to set the rates for the upcoming calendar year. When inflation suddenly spikes in the healthcare system, say unit costs for hospital days surge or pharmacy utilization spikes, the MCO, Molina in this case, absorbs the entirety of that blow in real time.
The state doesn't just adjust the monthly premium because Molina had a bad quarter.
No, the premium is locked in by contract. So Molina eats the 5% trend while surviving on the 4% rate update based on old, lower-cost data.
Ouch!
Yeah. But management's optimism stems from the fact that this 5% trend has officially plateaued. They noted that the highest cost categories, specifically behavioral health utilization and professional office visits, have leveled off.
Okay, so the costs are elevated, but the acceleration has stopped.
Right. And that plateau is the critical trigger for margin recovery. If the trend is stable at 5%, it's only a matter of time before that 5% reality enters the historical data window that the state actuaries are looking at.
And when that window shifts, the state is mathematically obligated to update the rates to reflect the actual cost of care.
Yes, by federal soundness regulations. Management estimates that the broader Medicaid market is currently underfunded by roughly 300 basis points across the board.
Wow. That's a staggering figure when you apply it to their premium base. A 300 basis point shortfall means the industry is essentially operating at a 3% structural deficit relative to normalized margins.
It's completely unsustainable for the sector. I mean, we're seeing peer companies report negative margins in their Medicaid books. The state actuaries are going to have to close that gap in the upcoming rate cycles.
And for Molina, the operational leverage attached to that rate correction is immense. Let's do the math for the listeners. Management quantified it clearly. Every 100 basis points of MCR improvement equals $5 per share in earnings.
Right. So even a partial correction fundamentally reshapes the valuation. If states only close a third of that 300 basis point gap, meaning a 100 basis point improvement in the rate to trend dynamic, Molina drops an additional $5 to the bottom line.
That single variable nearly doubles their current 2026 earnings guidance.
And management was careful to note that they don't even need the full 300 basis point correction to hit their internal targets. They're only modeling for about 90 basis points of MCR improvement to get back to their historical normalized margins.
Which implies a massive margin of safety for your investment thesis. You aren't banking on the states being overly generous or perfect in their true-ups. You just need them to be moderately competent in recognizing the baseline inflation that has already occurred.
Exactly. But the rate dynamic is only half of the Medicaid equation. The other half is membership attrition, driven heavily by the shifting regulatory environment.
Right. Let's get into this. We are seeing the implementation of new Medicaid work requirements and a return to stringent biannual eligibility re-verifications across several states. Now, just a quick neutrality check for you listening. We are not here to opine on whether work requirements are good or bad public policy.
No, absolutely not. We have to look at the upcoming membership churn through a strictly financial lens.
Purely the financial impact on Molina. And management expects these rules to cause an 8% to 9% decline in membership over 3 years. That's roughly 2% to 3% attrition per year.
And the velocity of that attrition is the most important data point here. We have a very recent historical precedent for what happens when membership drops rapidly. Remember when the pandemic era continuous enrollment provisions ended?
Oh yeah, the industry experienced a brutal, chaotic unwinding. And the financial devastation wasn't just about lost revenue, it was driven by the acuity shift.
Right, the acuity shift. The members who were dropped first, or who simply failed to return the paperwork, were disproportionately the healthiest members who weren't actively utilizing the healthcare system.
While the members who fought through the administrative friction to stay enrolled were the ones who desperately needed the coverage, the highest cost, most acute patients.
And that dynamic caused a massive 250 basis point deterioration in margins across the industry. The risk pool was fundamentally degraded overnight. You lost the healthy premiums subsidizing the sick claims.
But management is drawing a hard line between that chaotic pandemic unwinding and this new wave of regulatory attrition. They say this slow roll will result in only a minor and protracted acuity shift.
And their argument rests entirely on the predictability and the speed of the implementation. Because states are rolling these work requirements out methodically, the MCOs and the actuaries have time to adjust.
Management pointed to the Nebraska example. This blew my mind. They said Nebraska generated 290 pages of specific diagnosis codes just to define the parameters of medical frailty for exemption purposes.
Right. And at first glance, a 290-page manual for a single definition sounds like an administrative nightmare. But for an actuary pricing risk, 290 pages of clearly defined, codified medical criteria is exactly what you want.
It removes the ambiguity.
Yes. It means the state is methodically sifting through the population using rigid data points rather than just blindly dropping people who miss a mail-in deadline.
Which translates directly into forecasting accuracy for Molina, making it highly predictable for investors. It's a slow, predictable slope rather than a cliff.
And because it's protracted, those state actuaries can easily bake that minor acuity shift into the next year's capitation rates. It becomes a known variable.
Okay, so the core Medicaid business is essentially navigating this trough year, waiting for the rate corrections. But let's move to segment 2, because while Medicaid is treading water, the Medicare segment is producing some truly unexpected results.
Medicare is undoubtedly the surprising star of this earnings print, but it requires a very nuanced read, because the aggregate numbers are blending two wildly different strategic outcomes.
A tale of two products, basically. Let's look at the aggregate data first. The Medicare MCR printed at an incredible 90.7%. That performance was so strong that they actually lowered their full-year MCR guidance for the segment, from 94% down to 92.2%.
That 180 basis point improvement in expected MCR is a massive driver of capital efficiency.
And it flipped the EPS contribution of the entire segment. Medicare is now slated to contribute 25 cents per share in earnings for 2026. But, and this is but that 25 cents is totally driven by their duals product, which is making $1.25 per share, offsetting their MAPD product, which is losing $1 per share.
Yeah, we have to translate the jargon here and separate those two businesses. MAPD, or Medicare Advantage Prescription Drug Plans, is the standard commercial Medicare product. It's incredibly saturated, cutthroat, dominated by massive legacy players.
With deep pockets for marketing and broker commissions, and Molina is clearly losing that battle, bleeding $1 a share. But their success in the duals market is fascinating. Can you explain the difference between MAPD and duals for the listeners?
Sure. Duals refers to Medicare Medicaid plans, or MMPs, for people eligible for both programs. Historically, the dual-eligible population is the most complex and expensive cohort in the healthcare system.
Because under the old fee-for-service model, their care was completely disjointed, right?
Exactly. Medicare covers the acute hospital stay, Medicaid covers the long-term nursing facility, and neither side talks to the other. It resulted in massive redundancies.
Which is why states push this population into integrated managed care plans. They pay Molina a blended rate to take on the entirety of the risk. Single point of contact.
Right. And the theory is that holistic care management drives down overall costs. And Molina's data proves it works. When management originally priced their new duals products, they were conservative. They expected a 6% medical cost trend.
They assumed the population would run hot.
But the actual trend is coming in at 4%. That 200 basis point delta is pure margin expansion, and costs are lower across the board.
Specific details here. Pharmacy, inpatient, and even LTSS, long-term services and supports.
Which is usually the black hole of dual-eligible spending. If they're a beating trend on LTSS, keeping patients safely in their homes rather than a skilled nursing facility, their care coordination models are highly effective.
So you have duals crushing it and MAPD hemorrhaging money. And management's response to this divergence is the actionable insight for the listener here.
It's the single most bullish signal in the entire earnings call. They announced they are completely abandoning the MAPD product line in 2027. Outright exiting.
To stop the bleeding. They aren't trying to fix it. They aren't trying to reprice it. They are just walking away from the table.
It's a phenomenal display of operational discipline. A textbook example of ruthlessly cutting losers and feeding winners. Too often, management teams fall victim to the sunk cost fallacy.
Right, pouring millions into a failing product just to maintain market share.
But Molina looked at the math, realized they have no competitive advantage in MAPD, and pulled the plug.
And the immediate financial implication is stunning. By exiting MAPD, that $1 per share loss magically disappears in 2027. They don't have to sell a single new policy to generate $1 of earnings growth next year. They just have to stop doing the thing that's losing money.
It's a massive, massive bullish signal. But, the discipline they showed in Medicare stands in stark contrast to the absolute disaster they're managing in Segment 3.
Yeah. The problem child. The marketplace and exchanges. The data here is a bloodbath. The marketplace MCR spikes to 88.9%.
And the EPS guidance for this segment was slashed by $1.50. They were expecting a 75-cent gain for the year, and now they're guiding to a 75-cent loss.
A $1.50 negative swing on a single segment mid-year. So what went wrong here? Management knew this business was getting tough, so they tried to shrink their footprint by jacking up premiums, right? By an average of 30%, some up to 45%.
Yeah, their strategy was to intentionally shrink their risk exposure by making their product the most expensive option.
But the execution triggered the worst possible outcome. It's like if a restaurant raises its prices by 30% to thin out the crowds, but the only people who stay are the competitive eaters eating you out of house and home at the buffet, you've got a problem.
That is exactly the dynamic of adverse selection. The healthy individuals saw a 30% rate hike and immediately switched to a cheaper competitor, but the highly acute members didn't flinch.
Right. The members who stayed were the sickest ones, those on highly expensive therapies for HIV or oncology.
Think about the incentives. If you're reliant on a specialty drug that costs thousands a month, and Molina covers it, you are completely inelastic to premium changes. Even if Molina is $50 or $100 more expensive per month, you won't switch plans.
You gladly absorb the extra premium to guarantee continuity of care. So Molina consolidated the sickest patients. But wait, shouldn't the federal risk adjustment program subsidize plans that take on disproportionately sick populations?
Yes, the risk adjustment transfer formula is supposed to be the great equalizer. But this is where we have to break down the HCC disconnect.
HCC hierarchical condition category. This gets a bit deep, but it's crucial.
Every chronic condition corresponds to a specific HCC code. The federal algorithm looks at all the HCC codes. If a plan has a sick population, the government mandates a transfer of funds from healthier plans to subsidize the sicker plan.
So if Molina had all these oncology and HIV patients, they should have gotten the federal subsidy to offset the high medical costs, right?
In theory. But the fatal flaw was that the utilization of the expensive therapies didn't match the documentation of the HCC codes.
Wait, how does a patient consume thousands of dollars of specialty drugs without triggering the corresponding code?
Because the federal risk adjustment model relies heavily on specific diagnostic encounters. A pharmacy claim for a drug does not automatically generate an HCC code. The code must be generated by a comprehensive diagnostic visit with a provider during that calendar year.
Oh, wow. So if a patient just gets their prescription refilled but misses their annual workup with their specialist?
The federal algorithm assumes that patient is healthy. Molina paid for the massively expensive drugs, but didn't get the government subsidy to offset it.
That's a catastrophic breakdown in data flow. And to compound the misery, there was a $1 prior year drag split between risk adjustment true-ups and program integrity items.
Meaning the government clawed back prior revenue, or state audits disputed certain coding practices resulting in penalties.
So they're bleeding cash currently and paying for the sins of the prior year. What is the forward fix here? Management says they are reducing exposure by another $1 billion in 2027.
Which is just doubling down on the shrinking strategy.
But I have to question, can you ever truly price yourself out of adverse selection? If 30% hikes didn't work, won't shrinking by another billion just condense the risk pool even further into only the absolute sickest members?
It's a highly legitimate risk.
Yeah.
But management assumes that by aggressively downsizing, they can at least get the segment to break even, which would add $0.75 back to EPS next year.
Just by stopping the 75-cent loss. Okay, let's move to segment 4. The Florida factor and G&A leverage. This is another area of short-term pain for long-term gain.
Right. Q4 2026 is going to see a massive $1.50 per share headwind due to the implementation of the new Florida CMS contract.
Let's break down that $1.50 drag because it's split into 3 50-cent buckets. The first is 50 cents for pre-revenue G&A in Q3, meaning hiring staff before the state pays a dime.
Yeah, you can't just turn on a massive network overnight. You have to hire case managers, lease office space, integrate IT systems, and you're paying salaries months before the state goes live and starts remitting capitated payments.
The second bucket is another 50 cents driven by accounting margin reserves. Standard conservative booking for new business.
Right, specifically related to IB&R, incurred but not reported reserves. When the population launches, patients go to the doctor, but the claims don't hit Molina's system in real time. There's a billing lag.
So Molina knows the liability exists, they just don't know the exact amount yet.
Exactly. Because it's a new population with zero historical data, standard practice dictates they must book a massive IBNR reserve to cover the worst-case scenario. It locks up capital and drags down the recognized profit.
And the final 50-cent bucket is assuming a hot MLR medical loss ratio out of the gate while the network stabilizes.
Whenever you transition hundreds of thousands of members, chaos ensues. Patients are confused, providers are confused, utilization spikes before care management protocols take effect.
So you put it all together and it's a $1.50 crater in Q4. But the silver lining here for the listener, this $1.50 is a one-time drag. By 2027, this transforms into a $6 billion annual revenue engine.
And that brings up the math of scaling. G&A leverage.
Right. As Molina grows from $42 billion to its $64 billion target, management projects their G&A ratio will drop below 6%. The math here is fascinating. Half of G&A is fixed, growing with inflation, and half is variable, growing with revenue.
So as you scale, if you ingest 1 million new members from Florida, your variable costs go up, you hire more call center staff. But your fixed costs, your corporate headquarters, your core software licenses, they remain static.
Scaling automatically improves margins because you're amortizing those fixed costs over a vastly larger base.
And management also hinted at AI as a pure upside to reduce administrative labor costs, which isn't even baked into their current guidance.
Which implies the margin expansion could be even more aggressive. Okay, we've mapped the operational landscape. Let's synthesize all of this into segment 5, the 2027 leap, unpacking the $10 building blocks.
This is where they lay out the financial architecture for the next 12 months.
And the data they provided is audacious. The 2027 premium target is $46.5 billion, representing 11% growth. But the anchor metric is the 2027 EPS target. Management stated they expect to earn more than $10 per share.
Yeah.
Okay, I have a challenge here. They're guiding to $5.25 this year, but promising over $10 next year. That's a near doubling of EPS. How exactly do they plan to pull a rabbit out of that hat?
Well, the CFO provided an exact mathematical bridge to prove this isn't just a pipe dream. Let's walk the listener through the exact math. Step 1, start with the current $5.25 guidance.
Okay, $5.25.
Step 2, add $4.50 from embedded earnings. This is mostly just the reversal of the known one-time drags we've been discussing.
Right, the reversal of the $1.50 Florida cost and the $1 MAPD loss plus the operating leverage from scaling. That's $2.50 right off the bat just by stopping the bleeding and letting Florida go live.
Exactly. And step 3, add $0.75 from getting the marketplace back to break even.
Okay, so $5.25 lent plus $4.50 embedded plus Cyber 75 marketplace stabilization, total so far, $10.50. The math is elegant because it relies entirely on some traction and normalization. But there are headwinds, right? The revenue target was slightly lowered from $48 billion to $46.5 billion. Why?
Well, we already accounted for the $1 billion reduction in the marketplace footprint. That was intentional. The other $500 million headwind is because California is moving undocumented immigrants out of managed Medicaid and into fee-for-service.
Just a reminder for the listeners, keeping this strictly to the financial impact, $500 million in lost premium sounds like a massive blow.
But the CFO was adamant that the margin impact is de minimis because of risk corridors.
Explain risk corridors.
When California rolled this population into managed care, they didn't have historical data. So they instituted a tight risk corridor to cap both the upside profit and the downside loss. The profit was artificially clamped near zero by the state's guardrails.
So losing that revenue shrinks the size of the company on paper, but removes almost zero intrinsic earning power.
Exactly.
And what's the upside catalyst? The $10.50 assumes zero improvement in the Medicaid rate environment.
But if states correct the Medicaid rate underfunding early in 2027, every 100 basis points equals $0.75 per share in the early updates. That could stretch the target past $11 easily.
Okay, we've analyzed the core engine, the structural contradictions, the math. It's time for the final verdict. Talk Ticker's verdict, opinionated and actionable. Is a MUM HH a strong buy, a hold, or a weak fold right now?
It's a bullish hold for the patient investor.
A bullish hold. Walk us through the rationale.
The headline, $5.25 EPS for 2026, looks weak on paper, but it's artificially suppressed by $2.50 in one-time costs, the Florida rollout, and MAPD exit. The underlying earning power is actually $7.55 right now.
With 90% contract retention and duals outperforming, the path to $10 plus in 2027 is highly credible.
It really is. But here's the warning. Retail investors should brace for a potentially ugly Q4 headline earnings miss because of that heavy $1.50 Florida startup cost.
Right. Automated algorithms might trigger a sell-off. So the actionable advice is, do not panic sell on Q4 numbers if the core Medicaid trend stays stable at 5%.
Use any Q4 weakness as confirmation that the $6 billion revenue engine is launching, not as a sign of deterioration.
Perfect. That is how you parse an earnings call. But I want to leave you, the listener, with one final provocative thought to mull over. As states face tightening budgets, we're seeing changes to 1,115 waivers, provider taxes. They will inevitably try to squeeze Medicaid funding.
Austerity is coming to state budgets.
Right. But if managed care organizations like Molina inherently save states 10% to 15% compared to fee-for-service, do budget crunches actually give Molina more negotiating power in the long run? Will states be forced to lean on Molina harder when the federal money dries up?
It's the ultimate paradox. Does systemic austerity actually make the private operator indispensable?
Exactly. Something for you to consider as you watch the regulatory landscape evolve. Thank you for joining us on this deep dive into Molina Healthcare. Keep digging into the filings, keep questioning the headline guidance, and we will catch you on the next deep dive.